Alright, we're going to work on Monster Incorporated, and we're going to create their operating cash flow section of the cash flow statement. So let's get their heading set up. So the heading has the name of the firm, statement of cash flows, and then for the year ended, they don't tell us the year, but this that would be the per heading, and so we're going to do the operating cash flow portion. And here we're going to have to analyze the change in various accounts in order to extract the reconciling items that we need. So the first item is always net income, and they don't give us net income. We're going to have to figure out net income. So what account up here does net income change so that we can study the activity in that account and find net income? Retained earnings. So let's set up a T account for retained earnings and let's solve for net income. So here's a T account for retained earnings, so let's populate it and solve for net income. So beginning retained earnings is $45,000. Ending retained earnings was $111,000. And what makes retained earnings go up? Net income, that's the thing we need to solve for. And what makes retained earnings go down? Dividends. So 45,000 plus something minus 19,000 gave you 11,000. So you can set that up as X if you like and solve for the missing piece. And once you've done the math, I've gotten 85,000 here, but once you've done the math you can prove it, which is really nice, by taking 45,000 plus whatever you computed less 19 and make sure that it does equal the 111,000. Okay, so net income is 8,000, so let's put that back in here. Alright, now we're ready for the next item. Usually the next thing I do is add back in the depreciation expense because that's not a payment. So let's see. There were no sales of long-term assets during the year. That means the only shift in accumulated depreciation was the depreciation expense, because if there were no disposals, there was no removal of accumulated depreciation from that account. So that entire increase was depreciation expense. So that shift from 52 to 58, 6,000 would be added back. Alright, the change in common stock account would be reported where? Not under operating, but financing activities with owners. The change in accounts receivable. Now that will be a reconciling item between net income and operating cash flow. Accounts receivable went down. That means that what we collected was bigger than what we billed. And a little cheat sheet way to remember: if assets go up, reduce net income. If assets go down, we would increase net income, be the opposite. So let's do that. So there we are, recording that 4,000 shift in accounts receivable that was due to a difference between what was billed, what was in net income, and what went into the checking account, what was collected. Okay, what about prepaid insurance? How does that work? The only way prepaid insurance can go up is by making a payment, and it goes down by insurance expense. So that increase in prepaid was more payments than what got in net income, more payments than what got expensed. So we would reduce net income for the payments that were not yet expensed. What about accounts payable? That's going to create a reconciling item between operating cash flow, between net income and operating cash flow. Can you figure out the direction? Use that rule. If assets go up, you subtract. So liabilities is the opposite. Liabilities went up, so what would you do? Did you figure that out? We would need to add. There was no change to the building, and even if there was a purchase, a building would have gone under investing. Any cash flows related to that would go under investing. We already took care of the depreciation expense, and we already analyzed retained earnings. The dividends were a cash payment, but they would go under financing. So I get 97,000 when I add them all up.